Australia's cash rate hit 4.35% on Tuesday, the highest level since November 2011, and bank stocks went up anyway. That is the contradiction driving Wednesday's ASX session. A rate hike should tighten margins on variable mortgages, squeeze borrowers, and cool the banks. Instead, Commonwealth Bank climbed 2.65% to $177.44. Westpac surged 3.75%. NAP rose 3.09%, and ANZ gained 3.17%. The ASX 200 Financials Index added roughly 2.4% on the day. The mechanism is not complicated once you see it. The RBA's decision was an 8-1 majority, compared to a narrow 5-4 vote in March. That margin signals the board's near certainty, not panic. It tells the market the hiking cycle is close to done. CBA's head of Australian economics, Belinda Allen, put it directly. The RBA now has space to sit back and monitor. Her base case is rates on hold at 4.35% for the remainder of 2026, with possible easing only in 2027. Markets took that as a green light. If the peak is in, banks become income assets again, rather than risk assets. At 4.35%, net interest margins widen before new bad loans appear. Australia has not had a meaningful recession for decades, and unemployment remains healthy, giving lenders runway. The causal path behind this hike, however, is not benign. The RBA's own May statement on monetary policy shows inflation forecast rising to 4.8% by June 2026, up from a prior estimate of 4.2%. The culprit is fuel. Brent crude climbed more than 50% since the Iran war began, driven by the Strait of Hormuz blockade. Energy costs are feeding into business input prices and consumer expectations simultaneously. The RBA noted early signs that firms facing cost pressure are beginning to pass those costs on. That means the rate story is not over. CBA's Allen acknowledged another hike cannot be ruled out if wage decisions, consumer spending, or the June quarter inflation data surprise to the upside. The 4.35% figure is a ceiling only if oil prices fall back towards $75 per barrel by 2027, the assumption baked into the RBA's own model. Whether that assumption holds depends on what happens in the Strait of Hormuz, and that is exactly where the picture changed on Wednesday morning.
The Strait of Hormuz is still partially blocked, but Trump blinked first, and the Australian dollar felt it immediately. U.S. President Donald Trump announced that American naval escort operations through the strait would be paused. Secretary of State Marco Rubio confirmed that Operation Epic Fury had concluded. Brent crude slipped to around $108 a barrel from its recent highs, its second consecutive daily decline, and the Australian dollar surged as much as 0.9% to US 72.5 cents, a four-year high, its biggest single-day move this month. The AUD's strength runs counter to what the RBA hike would normally produce in isolation. Rate differentials usually attract capital and lift the currency, but the dollar was already moving before Tuesday's decision. The real driver is the ceasefire signal. Lower oil prices reduce Australia's import bill, ease the inflation trajectory, and reduce the odds of further hikes, all of which together raise the risk appetite for Australian assets relative to the US dollar. This is where the commodity split becomes critical. A stronger AUD cuts the local currency revenue of every miner and energy company that sells in US dollars overseas. BHP closed up 1.69%, and Rio Tinto gained 0.66%. Miners recovered Wednesday because gold prices surged to $4,648 per ounce, and broader risk appetite returned. But Woodside Energy fell 2.35% as lower oil prices directly compressed its expected revenue. The asymmetry is sharper for importers. Wesfarmers, JB Hi-Fi, and Ampol all benefit structurally when the dollar is strong. Cheaper imported goods, lower fuel costs. The Hormuz blockade has been suppressing those benefits. If the ceasefire signal hardens into a full reopening of the strait, the AUD tailwind combines with the oil decline to push retail margins higher. JB Hi-Fi is the complication here. The retailer shares dropped more than 6% on Wednesday despite the macro tailwind. The company warned that supplier component costs are rising and product shortages are biting, not from the war, but from the global data center boom consuming semiconductor and electronic supply chains. That is a separate force entirely, and it points toward the third chain running through today's session.
On the same day, JB Hi-Fi fell 6% due to GPU shortages. Infratil surged 12.7% because a hyperscale tenant signed a 30-year, 555-megawatt contract with its data center subsidiary, CDC. The size of that deal reframes the Australian digital infrastructure market. CDC's total contracted capacity now exceeds 1 gigawatt, more than double its previous base. The 555 megawatts alone represents roughly 40% of Australia's entire expected data center operating capacity as of 2025. The counterparty is described as a U.S. investment-grade customer, suggesting a major cloud or AI infrastructure operator. Infratil shares hit $11.83, extending the stock's year-to-date gain to about 23%. DigiCo Infrastructure REIT added to the momentum, surging more than 25% after announcing the $1 billion sale of its Chicago data center site. DigiCo is now concentrating capital on its flagship Sydney facility rather than expanding across North America, a strategic pivot toward the domestic supply gap that CDC's deal just confirmed is real. The mechanism linking these two events to JB Hi-Fi is the same AI-driven demand shock. Hyperscale operators are hoovering up semiconductors, power infrastructure, and networking equipment at a pace that is pulling components out of the consumer electronics supply chain. JB Hi-Fi CEO Nick Wells specifically cited significant supplier component cost increases and stock availability shortages tied to data center build-out. The retailer that benefits from a stronger AUD is simultaneously being squeezed by the very infrastructure investment drawn in Infratil's record contract. CDC has maintained its FY27 EBITDA guidance of $680 million to $720 million, with FY28 expected to exceed $1 billion. That guidance assumes the current pipeline of roughly 1.6 gigawatts through 2034 proceeds on schedule. The risk to that outlook is financing. Emerald Resources and other project developers have shown that approvals alone do not guarantee build timing. The leaning here tilts toward the infrastructure side continuing to outperform. The CDC contract provides 30 years of revenue visibility with a 20-year extension option, and the deal required no additional capital beyond existing plans. Infratil's $3.9 billion in cash and undrawn facilities as of March means the balance sheet is positioned to absorb further development. For JB Hi-Fi, the supply chain pressure is a function of how long the AI build-out concentrates demand at the component level, a cycle measured in quarters, not years. The verification benchmarks to watch: Brent crude holding below $108 per barrel would confirm the ceasefire signal is real and reduce the RBA's incentive to hike again beyond 4.35%. CDC's FY28 EBITDA crossing $1 billion would confirm the data center thesis on schedule. And if JB Hi-Fi's supplier cost warnings extend into the June quarter update, the AUD tailwind alone will not be enough to offset margin pressure, which will prove the commodity and retail split is deeper than today's session suggests. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.